I'd like to call to order the regular quarterly investment committee meeting for the Kentucky retirement system. And could we have the opening legal statement?
Yes, sir. This is a regular meeting of the Kentucky Retirement Systems Investment Committee. This meeting is being broadcast via video teleconference pursuant to Kentucky Revised Statute Section 61.826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road, Frankfort, Kentucky. It is also being broadcast to the public via Facebook. If you are speaking and not appearing by video, please identify yourself before talking. Please ensure that you are on camera when making or seconding a motion or casting a vote. In the event the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to another date.
Thank you, Vicky. And Mary, will you do the roll call for us, please?
Of course. Mr. Lane,
Here.
Miss Bova,
Here.
Miss Hampton,
Here.
and Miss Thompson.
My internet keeps going out. I'm here. If you said my name, I'm trying to switch to a different Wi-Fi.
Thank you.
You're all live and ready, Pam. So and I understand we have no public comments, and that takes us to the approval of minutes of the May 31st and June. I can't read the print; it's too small. To the two minutes included in the book.
That was May 21st and June 3rd.
So could I have a motion to, unless there's some changes or revisions someone wants to make, may I have a motion to approve?
Pruitt, I was not at the May meeting, but I was at the June. I'm not sure if we have to do those separate or how do we, Vicky, is there any issues on that?
You should show up as not there.
Well, I wasn't on the committee then.
Ah,
Yes, if you weren't on the committee, then we probably should take them separately.
okay, let's do the, like I said, I can't,
May 21st, 2026.
the May 21st meeting. Could I have a motion to approve those minutes?
So moved.
Oh, second.
Okay, any objections? Hearing none, those are approved. And the May 26 minutes, could I have a motion?
You mean June 3rd, 2026?
I'm sorry, what was the date?
June 3rd, 2026, the second set.
Oh, the June 3rd minutes.
I'm a motion.
Bruce.
And any objections or changes needed? Hearing none, those minutes are approved. And so now we have, again, I'm sorry, I can't even, I gotta figure out how to enlarge this, but what's the next item on the agenda?
You're up to the investment review and update.
Oh, investment review and update. We, as you may have noted in the onboard announcement or change, I've had a couple of trustees who have been noticing all of the press, let's call it, about the private equity and as well about private debt. And so we added some, Steve and the staff did a wonderful job of putting together where we are and where we aren't, more importantly, in the world of private equity and private debt. And just a couple of comments. There was one article that said there were 33,000 private equity investments that were hung, couldn't be sold. And as Steve will tell you, a lot of those are very, very dated. There is movement in private equity deals, but not a lot. And the IPO market hasn't been terribly open for those. And so we are seeing secondary transactions. Those sometimes come out at less than 100 cents on the dollar. And unless Steve has seen any others, I don't think any of them trade for more than 100 cents on the dollar. So there is
Not seeing a lot of premiums, no.
But and then the other world is that affects us, but doesn't affect us, is the semi-liquid BDC debt that's coming out. I think there are like 49 different funds that are out there. BDCs are business development companies, and basically a lot of them are the debt backing private equity. And you'll see the headlines on one of the slides in the pages on that additions that are kind of remarkable. How many how many things are going on in that world, and it's not pretty. The good news is we'll get into in just a second is that we don't have any of those, and our private debt is in a different world and is not dependent on the liquidity that these 5% tenders supposedly provide. Those are retail deals. Those are there may be some insurance companies buying those, but more sophisticated and larger investors are not buying those funds. That Blue Owl, you may have if you watched CNBC, you know they have they used to have the two guys that own Blue Owl on about 3 days a week. And that's always a tip off that they're trying to sell you something. They're not there to talk about the weather, and they're in real trouble. Uh, BlackRock, Blackstone, many KKR have all stubbed their toes on these types of debt. So I'll turn it over to Steve, and he can tell you what we don't have. Maybe I've told you a little bit, and then what our approach is, and why what we see happening there.
Sure. I think we can jump right in. Pruitt obviously stole some of my thunder. Thank you, Pruitt. But we can jump to page 83.
That's what they pay me for.
I know they pay the big bucks for it. So as Pruitt was saying, there's we've all seen a number of headlines. Some of these are doomsday, which obviously get clicks, or I guess you don't really sell papers anymore, but get clicks of viewers. And so as he mentioned, we put together and staff did a great job putting together slides on short notice to kind of give you an overview of where we are, kind of where we are relative to some of these headlines. And really, as Pruitt mentioned, they're primarily two focuses of a lot of the headlines. And if we switch to page 85 as well, they're really regarding liquidity as well as concentrated exposure risks in private markets, private equity, and private credit. And jumping back to page 77, the KRS and SPRS pension portfolios have a 20% target to specialty credit. All of the other portfolios have a 25% current target allocation. And as we've discussed at prior meetings, specialty credit is not, a term you hear in the industry. It's not really an industry standard asset class, but one that was created specifically for our asset allocation. And it includes broad private credit, as well as everything below investment grade in the public fixed income markets. That graph on the right shows the current composition of this specialty credit asset class. And this is using the KRS and SPRS pension portfolios, which again have a 20% target to that specialty credit. Within specialty credit, we've roughly targeted a 50-50 split between public and private markets. But that allocation has and will change over time based on our analysis of market conditions and investment opportunities. So as well as unique cash flow experience of each of the plans, and the timing of that will dictate what the investment opportunity is. But I think it's fair to say that from your seats, we kind of roughly target a 50-50, and we have consistently done that with, again, it'll move over time. Currently, 50% of the portfolio's investments are in public market securities, and those include high yield bonds and loans, as well as what we call global opportunity credit. And those are all publicly traded. And then 50% is invested in what are dedicated private funds. So strategies that are investing purely in private credit or private debt, and then hybrid private credit. And those tend to be a little more opportunistic, where the manager has latitude to take advantage of what they see in the market, and they may invest in some public securities, some line item CUSIPs, and then they also have the ability to invest in private credit. So that's kind of a hybrid. If we go to page 78. Thank you. It shows the breakdown by manager and strategy of that 50% that is invested in these dedicated or hybrid private credit mandates. Performance of this allocation has been very strong, as we'll note when we get to performance and allocation. Lynn, do you have a question? Sorry.
Yeah,
Lois?
just, since I'm new on the committee, if you could go back to the allocation of 50/50 allocations, just say 4 years ago, if we were looking at this, how much money did we have in specialty credits? Was it also around 20%?
So that's changed with the most recent asset allocations. We remember we upped. So over the last two, and I'll say this, asset allocation's been an evolving process. So originally there was a higher allocation to I think it was to the overall specialty credit that was reduced with the prior asset allocation, and then it was bumped back up to 20% and 25% targets. And that 25% targets for all of the other funds was higher than it was prior to the reduction. That really was dictated as Wilshire will talk about capital market assumptions when they go over the economic and market overview. But that's largely been driven again where opportunities are in the markets. As we talk about a lot in these meetings, where we see opportunity, the rise in from that zero interest rate world. So yield and spread assets, primarily fixed income, really offer a very compelling opportunity right now, kind of given the all-in yields and risk return profile that they offer relative to other asset classes.
Okay, and so specialty credit really does not have any federal regulation, is that right?
It's not what I would call so typically you think of the standard industry asset classes, public equities, right? That's pretty well understood. You don't see specialty credit as an asset class used broadly in the industry. That was created specifically for our asset allocation when we first started investing. Remember, there used to be an opportunistic bucket, there used to be an absolute return bucket, and there used to be a global bond bucket. And the global bond bucket, when we first started investing in private credit, the first few investments, that's when the decision was made to combine and create an allocation that is both this kind of public market as well as private market. And again, the public stuff is going to be everything really below investment grade. So the core fixed income is kind of your investment grade government bonds, investment grade corporate bonds, structured securities that you'll see in that core fixed income allocation. So think of that as primarily investment grade. Specialty credit is unrated in the private side or below investment grade on the public side, primarily.
Okay.
Lynn, can I give you a little background on how that happened?
Yeah.
Not us, but that world.
Either now, or if everybody else knows it, over a glass of wine when you get back.
I'll make it quick.
Okay.
Specialty credit evolved because of the financial crisis, where banks stopped lending.
Mhm.
Banks were afraid to expand their lending into things they may have not been that knowledgeable on. So that's when the private credit or specialty credit world evolved and really put a dent in the high-end lending of banks for a good while. The banks are trying to get back into that, but these were people, the specialty credit people could make decisions in a week, not months,
Mhm.
and demanded maybe fewer or different covenants, maybe more covenants, but they were willing to make these loans, and so that world evolved from one that barely existed to one that in the last several years has been huge.
Yeah.
Yeah, you'll often hear it called, non-bank lending, right? And what we've seen is the certainty of funding. So, if you look at even in some of the larger issuers, they could go to what's BSL, so the broadly syndicated loan markets, and get funding. Uncertainty regarding, how much they can get and pricing on that, whereas the private side, offers certainty and certainly, as Pruitt mentioned, from a timing perspective, can occur much more quickly.
Thank you.
Sure. Can we jump to page 84, please? And I think right before those questions, I was mentioning that performance for the overall specialty credit allocation has been very strong. We report that every quarter and every fiscal year. Over the last 12 months, it's produced 209 basis points of outperformance relative to its benchmark, and over the last 5 years has outperformed its benchmark by 229 basis points. Have been very accretive to overall performance of the systems. We're still very constructive on the asset class. It's a very broad asset class. There's been, as Pruitt mentioned, it really started off with middle market lending, right? That was the bulk of what we saw in the private credit side, and it's expanded into a number of niches, including some exposure we have to what's called ABL, or asset-backed lending, or asset-based lending. So there's new opportunities presenting itself all the time, things that the team is looking at. And again, I think we still, as we advocate for, we still find it one of the more compelling asset classes, especially given its lower risk profile, and still really attractive all-in yields and returns. As we mentioned, the two most prominent headlines in private credit have been that liquidity, which, as Pruitt mentioned, is the BDCs, and that's business development corporations, really retail-focused products. Just to let everyone know, the systems don't have any investments in these products and have not experienced those similar issues. And as we've seen, that the gating is what they call it. So they have, by their governing docs limit how much they can, they receive requests for distributions and how much they can distribute typically on a quarterly basis. And then they can put up what they call gates, which further limit or restrict distributions. That's always potentially an issue when you take, what is an illiquid asset, and you put it in a liquid fund vehicle wrapper, and allow that. We see that sometimes with interval funds as well. We've seen it historically. I mean, there's a number of asset classes where they tend to work until they don't work, and liquidity often is the driver. We talk about the run on the banks. You see the headlines where people start requesting redemptions. They hold underlying illiquid assets that are difficult to sell. They can't meet those redemptions, which tends to be self-fulfilling and causes more redemption requests. So that's probably not an issue that's going to go away anytime soon. Managers are creative in the way they handle those and what they've been able to do. But that's still going to be kind of an ongoing issue. The other real headline we've seen, and it's died down a little bit in the past couple of months, but there's been several on technology exposure. Obviously AI is still a very thematically important investment thesis in the markets, but there's been a lot of struggle, and there was a struggle certainly in the first quarter of the year with this technology exposure in specialty credit and in private equity. While technology exposure is significant in the broader private credit asset class, and there's in fact funds and strategies that are dedicated exclusively to technology investing, the systems exposure is really pretty limited, totaling just 140 basis points of the overall specialty credit allocation, or just 30 basis points at the total fund level. That's been driven by kind of how we structure and what we look at from an investments. Where some of that technology investing, as we see, is on the private equity side, as Anthony may talk about, is more venture related, and that's not an area that we've necessarily played in. And dedicated strategies, I think we look for more broad mandates. We like hard assets. We like being up the capital structure. So that's not been something that obviously we've invested heavily in. We do have some managers that have some exposure to that. They tend to be limited by their guidelines as to how much industry or sector exposure they can have within a particular fund. Unless there's questions, I'll turn it over to Anthony to talk about some of the private equity exposure and some of the slides we put together.
Help protect your mobile device against malicious.
Anthony?
Yep. Okay. Can you all hear me? I'm having camera problems, but I guess hopefully you guys can hear me. Like Steve was saying, yeah, we don't have a lot of tech exposure. It's hard for us to get meaningful amounts of growth and venture exposure, given our size and the processes we have. This numbers we went through actually, and we're still working through some data with a new provider. And so the numbers are a little bit bigger. It's more like probably 55 basis points for private equity, because there was a venture fund of funds that didn't get picked up, which is pretty much all tech. So it's a little bigger. It's still, less than 60 basis points of the portfolio. But that fund is 17 years old and counting. So, and I think that just shows how illiquid some of these are, and you know, what can happen when you have a lot of legacy things that they don't have to sell. I mean, you just have to know going in, like Steve said, with the interval funds and other things like that. Semi-liquid, probably just means usually illiquid. People just have to be prepared for that. And there has not been as much understanding maybe in the retail world of that. We obviously have long dated liabilities, so we're set up to invest in these longer term things. And ideally, if it's something that's attractive, we could be liquidity providers for that. Steve and I actually had a call this week with a strategy that's looking um, to tender for some of the funds that Pruitt was talking about. So your Blackstones, Blue Owls, BlackRocks, those are like the largest non-traded BDCs that make your CNBC headlines, so that people can feel worried and watch more. But yeah, so they have tendered for a Blue Owl one, and also a Starwood REIT. So that's a strategy that we are considering, since we already have capital with them, in a similar strategy with closed-end funds. So rather than having that exposure, that's something that as an institution we can hopefully take advantage of, rather than be long. So that we just want the trustees to kind of hopefully be feel more reassured about that. So let's see, it's going forward. I lost the slide, so let me find it for a second. So the next page is page 85. Again, this is the point that Steve was talking about. You see a lot of headlines because it's something that people click on or watch. These are things that we are not in, but hopefully can take advantage of with the strategy I was just mentioning. And yeah, I guess we'll just take it if there are any questions. Most of our private equity is. Oh, we can go back further. Sorry, they're behind us. So let's go to page 80. So you can see here, this is just Wilshire's assumptions. You can see how much the private equity assumed for returns have gone down. They're now below their estimates for real return and especially credit for sure by over 100 basis points, and now real return. So we have not been as interested in this area for a long time. We've made a few commitments, but we're not really as focused on the labels. It's more of what kind of exposures and investments are attractive and additive to the portfolio, since we can get cheap risk exposure. Brian and Joe can, and we don't have to pay all the fees and all the brain damage and legal for stuff like that if we don't think it's interesting and better or different. So, but yeah, I think this helps illustrate, to Lynn's question earlier about how things have changed over the past few years. We've been positive credit a lot, given, our roles here. I mean, we're trying to meet long dated liabilities, with the least risk possible. And so usually that involves less equity as possible, especially when contracted returns are attractive and higher. So we go to the next page here. As such, our private equity allocations is in the lower end of our range, and a lot of it is legacy stuff. The Bay Hills and the Horsley Bridge compose about half of it. Those are both fund of funds that date back from 2007, 2009. So again, you can see how long these things can last and linger around. Although sometimes they can be good because we're going to have a very large monetization from Bay Hills. A lot of that is one company that's being sold to Parker Hannifin and is expected to close later this year. I think we all saw the benefit of the valuation increase, I think, this past quarter. But yeah, it does set to close. And it was publicly announced fourth quarter of last year.
Let me just throw out a comment, and I'm dating myself, of course, because I'm old. But back in the 70s and 80s, there was a gentleman who ran the old Solomon Brothers named John Goodfriend. He was one of the smart guys. He used to say that there's no such thing as a bad bond. There's only bad prices. And that is something that is on the minds of a lot of smart people at the moment. This situation that they referred to, that taking a look at, is, I think he made a tender for Blue Owl at $64. Don't think Blue Owl was interested in that price, but they may not have a choice. So, this is an era where the really good investment people are going to make some almost comparable to the mortgage fallout back many years ago, the financial crisis.
That's right. Yeah, correct. And like this, and it is, it's a liquidity bid. Like and they do, these are folks that, they're targeting folks who have been in these liquidity vehicles in some cases for years and waiting in a queue. Like the Starwood REIT, I think there has not been liquidity for 4 years. So, you can tender for, you can, ask for your money and they can give you the 5% back a quarter. But if you need that sooner, then I think that's what they're trying to provide. So, they probably won't be the only one, but we'll see. It's early on that, so which and there's a debate out there about how much more redemptions could happen given everyone's behaviors. So we'll see. And go to the next slide here. And this just shows a lot of how aged the portfolio is. And this is kind of indicative of private equity as a whole. I think we have a slide that just overall private equity has been aging given the lack of exits. So I think we might be over half now of assets now. Companies in the P world are over 5 years old. So that's a past investment periods for funds. So if you look at the next page here on page 83, yeah, you can just see time and portfolio here. So there's the bottom left chart on the right with the gray bars. It's just aging. There's lots of aging B funds, and a lot of it's because the math just doesn't work, right? You bought this in 21 when rates were zero, and now and the valuations are not the same, either multiples or just the buyer can't pay as much given how much it's going to cost to finance. So yeah, that's so people were just waiting around to see if it gets better. And we've seen the same thing in real estate, right? But yeah, this has been a bigger phenomenon, I guess, in PE because of all the companies and maturities and things. So yeah, that's I think the headline on the left pretty much tells the story. 33,000 unsold businesses, and that's up more than double from 10 years ago. So it's not getting a lot better. So
Well, what's going to hamper any the returns is when particularly in 21, 22, the
mhm.
deals were done with the short-term floating rate debt that was at what 1.5%, 2% to most,
That's
something
right.
like that,
Hmm.
Anthony. And
Yeah, that's right. Yeah.
now those numbers are 5, 6, 7% uh,
Mhm.
and up, and the returns that were looked very, very good back then don't look so good right now.
No, definitely not. And if your multiples compressed, like in software or certain other sectors, then it's bad times. It's just math. It's not gonna. It doesn't work out too well. So
The economics become very challenging, yes.
mhm,
We see that day in, day out.
mhm. Yeah. So it's kind of like, I mean, it's just like with real estate and things like that. Sometimes, the folks who have new capital to deploy can maybe perhaps find different opportunities. I think that's why, people we are still interested in folks maybe spinning out and doing new things that have some record of success. But a lot of these assets, a lot of them are stuck and have been stuck and probably will be stuck for a few more years. So okay, if there's no other questions, then happy to turn it back over.
All right, well, thank you, Anthony. And
Yep, thank you.
before I forget, I also wanted to mention we have I believe Colby's on this call. Colby was our summer investment intern, and today is his last investment committee meeting with us. So happy to have him for the summer. Joe did the heavy lifting. Hopefully, it was a useful experience for Colby, and we hope to see him back. And with that, I will turn it over to Wilshire. I think they're going to provide hopefully a very brief, sorry guys, overview of the market and economic conditions for the last quarter.
Steve, before we go into that, I just want to thank
Yes.
you all for putting together a very good, understandable presentation. It was really a big help for me.
Well, thank you very much. All the credit goes to staff. They did all the hard work. So thank you.
All right, thanks, Steve. We'll keep this high level. If we could jump to page 16 of the books to touch on a few things that you and Anthony hit on. We can see here, Anthony had showed some of these assumed rates of return, also against where they were a few years ago. Last time he did asset allocation study, we see here private credit 7.65%, one of the highest returning asset classes based on our expectations over the coming 10 years, real assets also providing a compelling return relative to public equities and core bonds, which are both around 5.25%. So just wanted to touch on those since Steve and Anthony already hit on those. I won't belabor those points very much. On the next page, we see an update of a slide that we showed last quarter. Some activity returning in the Strait of Hormuz, but very choppy. Again, this remains one of the key geopolitical issues that's creating increased uncertainty and volatility in markets. Also potentially keeping higher pressure around inflation by keeping energy costs elevated, but haven't seen a lot of that trickle through. But we also haven't seen inflation really meaningfully be able to break below 3%. So still well above the Fed target, but also at the same time not as bad as maybe you would have expected given the chart we're showing here on the top of the page. I'm sure the story would be a little different if we were in Europe talking about this with the fall and winter months coming, and probably a lot more worries about heating oil and other energy. But for now, hasn't been a huge impact, but obviously increased uncertainty and volatility is what we're seeing and expecting to continue from this. I'll jump forward a few pages to page 21. There's in the interim, there's a few pages on the outgoing Fed chair, but here we'll focus on the incoming Fed chair, Kevin Warsh. A little background: he had been with the Fed, left in the middle of a term in 2011, and at that time had voiced some opinions about QE2, kind of a hawkish, not supportive of that QE2 program and what it was doing to the Fed balance sheet. So here's another example of something that is adding uncertainty to the market. And again, more uncertainty can lead to more volatility. It's something we want to keep an eye on. He's created these task force, which might be great in the at the end of the day. We'll just have to wait and see what they come back with. We've already seen on the communications front that he is not in favor of holding the market's hand as much. So we can expect less information to come out of the Fed under his leadership, which will again increase that uncertainty. But also maybe will, kind of take a bit of the Kool-Aid away from the markets if they're not, as sure about, the Fed being there and what they're going to do in the coming meetings. Rethinking how they're using the balance sheet. That one will be maybe the biggest of these 5 points, alongside thinking about how they look at the inflation measures that they're using. He's mentioned that the current way they look at inflation is, too much looking into the past and maybe looking for ways to get more up to the minute data. Will change the way they look at inflation and how they try to react to it. And then things like data, just reviewing the data sources they have and how they compile, and maybe potentially use things like AI to get a better handle on more data points. And productivity and jobs is related to that. Rethinking what we can expect from productivity and jobs. Obviously, half of their mandate is unemployment. We would expect increased in inflation from all this spending on data centers, but if there's a market increase in productivity, we might be able to see higher rates of growth without the same impact on inflation that some might be projecting. So all of these things are, smart to set these up and see what the outcomes are without knowing exactly what they're going to come back with. It's hard to say if any of these will have meaningful impacts, but just the initial impression of him is that we can definitely expect communications to be a bit more tight-lipped than they have been for the last going on 20 years. So if we skip down to the next page, just a little bit more on the Fed. What does it matter? Well, he's the chair, but he's still one member of a committee, so he can't necessarily change exactly, what the Fed is deciding to do overnight, especially when it comes to changing the Fed funds rate. And then, I like to hit on that Mike Tyson quote: everyone has a plan until they get punched in the mouth. It's great that he says all this stuff, and maybe he's viewed as more hawkish, but if we have a crisis pop up, the chances that the Fed doesn't step in and try to stabilize things are slim to none, He can talk tough, but at the end of the day, it's going to be really hard to resist the pressure to step in and to provide support. So probably not a meaningful change to how the Fed would react if we do find ourselves in another crisis situation. And on the next page, look at the impact on the Fed funds rate so far this year. You can see that second dotted line was when he started his term, so not much change there. But the red dotted line farther to the left shows the start of the conflict with Iran right at the end of February, and you can see from that point to now, we've gone from expecting, if I key in here on the red line, which is December, we've gone from expecting at least 2 cuts by that December meeting to pricing in at least 1 hike in rates by the end of the year. So a really marked change there. Think about the impact on expected inflation as being one of the main drivers here. Just looking at today's data, the probabilities on the Fed Watch tool are saying 45% chance of 1 hike and 20% chance of 2 hikes. So a 2/3 chance of a hike or 2 versus a 1/3 chance that we stay where we are. And the market's not pricing in any chance of any cuts at this point. So a really marked change there. And we've seen yields rise, particularly on the long end, to 20-year highs to the point where I think it was just announced today or late yesterday that the Treasury is going to step in and double their bond buying and try to provide some extra liquidity in some of these stressed areas of the market, maybe that are traded more thinly at the long end of the curve. And we're seeing yields drop a bit on that news already today. So a lot going on in the fixed income world, and it's hard to sometimes pull apart all the pieces of what's driving what, but it's a combination of factors. Deficits causing investors to maybe change their tune and demand higher real yields, pressure on inflation causing changes in expectations, driving these expectations for hikes instead of cuts. A lot going on. And jumping to page 25, we show this chart every quarter. If we look at the breakdown of what's been happening to the 10-year yields, we can see again those same red and black dotted lines. So going back to the start of this conflict at the end of February, we've seen the 10-year nominal yield go up to 4.5% as of the time this was produced, from about 4%. And if we look at the breakdown of what's driving those nominal changes, the real yield is higher, and the break-even inflation expectation is actually slightly lower. So it does seem to be investors demanding higher real yields to hold this debt. This is also in the backdrop of enormous issuance by companies that are trying to finance their AI build out and spend, leaning more towards debt now than just sucking up all their free cash flows. So an increase in corporate issuance as well. So again, investors seem to be demanding higher real yields given the debt level and deficit spending. And then I'll just hit one last page here, the next page, 26. Just a reminder that even with Warsh in charge now, cutting the Fed funds rate doesn't necessarily, at least in the short term, impact these longer rates. And obviously, I think a lot of the political pressure to get rates lower is for things like mortgage rates, right? So houses can become more affordable. Even if they cut rates like we saw in this last cutting cycle, things like the 10-year, which are more closely aligned to things like mortgage rates, don't necessarily move in the same direction, at least in the short term. So just a good reminder there that cuts or hikes might not immediately be reflected in some of these more, in fact, impactful rate markets. And with that, I think David was just going to touch on a couple pages real quick before we turn it back over to staff to cover your portfolio.
Thanks, Craig. Yes, I'll just hit a couple of pages. We had a lot of really good data, I think, from both Steve and Anthony's report and what Craig went through in the front of our deck. If we could go to slide 35, please. Just a couple of points to sort of, I suppose, set up for Steve's review. What did the quarter look like? It was the U.S. equity market was a 15.5% quarter, which put us at the end of June up 11% year to date. A lot of periods of volatility throughout that first 6 months. From then to today, we've had stronger equity returns. We're now sitting yesterday. The Wilshire 5000 index is up a little bit over 13% year to date. So that's gives you sort of a taste of the equity market, the U.S. equity market, up about 13% year to date. The next slide, I'll just hit on these next two slides quickly. This next slide, this shows the factor returns, and just go all the way over to the ones that jump right off the page at you. That's momentum. And that's what we've been experiencing in this market. In fact, we've been experiencing it like for 5 years. So look at all the blocks there. It's pretty much just dwarfed everything else driving returns. So this is what we've been on. It's been a big AI spend. We've got some other data in here that we skipped for today, but business spending is huge. Craig talked about their spending cash flow. And now they're borrowing new capital to spend further. So the CapEx build out for AI, it just has massive impact. And you can see it all in this momentum trade. On the next slide, this is just kind of a nice little reminder. We don't always go over this one, but if you're thinking about market sell-offs, here's a nice picture of the last 20 years or so. There's all kinds of ways you can look at this. Time to recovery, everything else when you have a sell-off, but we put this in our quarterly review quite often because it's nice to just have a reminder of what some of the years look like when we've had big sell-offs. You look back to years like, say, 2008 when we sold up by 37%. The largest peak to trough moment during that year was down 49%. And then you just look on, you can see, 2020 was a good example. 2020, we had a peak to trough moment. 35% negative and ended the year 21% positive. So just something you can always look back at this for reminders of what some of those sell-up periods look like. If we go to slide 40 on the non-US markets, similarly, the quarter, I'll just take the top line. Emerging markets were much stronger than developed markets. That's really coming out of South Korea and tech. And so if we look at just the ACWI ex-US top line for the quarter, 14.7%, year to date, 14%. Non-US markets have also continued on up about 16% through yesterday, year to date. So quite similar and a little bit stronger than US equity markets. And then finally, over on 41, just to set the stage for fixed income and just take the core space at the top, the aggregate index. That was a year. I'll take the year-to-date numbers are a positive 60 basis points. That already doesn't matter because we've had rates generally rise, and right now the aggregate index is a negative 33 basis points on the year-to-date through yesterday. So fixed income, just from a pure rate situation, it's been holding returns flat. Opportunities have been in some of the areas within fixed income, but you can see year-to-date numbers not strong. So I'll just stop there and hopefully leave plenty of time for you, Steve, to start through your section.
Well, thank you very much. Appreciate it. If there's not any questions, we'll jump into page 50, please. Sure, everyone is most interested in performance and fiscal year, and I think given those public equity numbers that David just showed, I think we'd all sign up for that every quarter. If we could just lock that in right now, would be great going forward. But as he mentioned, across the board, risk assets really enjoyed a very strong second quarter. Many markets bouncing back from what was a challenging March. Again, as they pointed out in the presentation, generally reduced tensions in the Middle East and that optimism around rising CapEx by the beneficiaries of AI. The equity rally also broadened during the quarter, I think, which was important to the health of the market, with all sectors participating in the rally, really except for energy, and small caps outperforming large caps by 526 basis points during the quarter, which again, I think speaks to hopefully the improving health, less narrowness to the public equity markets, which I think would be good for the long term. Investment grade and high yield credit spreads did tighten, but as the yield curve bear flattened after the hawkish FOMC announcement that Craig discussed, Commodities were one of the few laggards for the quarter as the price of oil tumbled over 30%. The KRS pension composite produced a return of 6.38% for the quarter, modestly underperforming the blended benchmark's return of 6.48%, while the KRS insurance composite produced a return of 7.35%, outperforming the return of the benchmark by 25 basis points. That's a pretty big dispersion between obviously pension and insurance, and that's largely driven by that asset allocation differences that we've talked about. The insurance composite across the board has higher allocation to public equities. Individual portfolio performance for the quarter ranged from 6.18% to 7.51%, with 5 of the 6 portfolios outperforming their respective benchmark. During the quarter, the largest contributors to performance relative to that benchmark were the outperformance in the real return and core fixed income portfolios, as well as the absolute overweight to public equities. The real return portfolio produced a return of 4.01% for the quarter, outperforming the benchmark by 78 basis points. That was driven by especially strong performance in the portfolio's activist closed-end fund, as well as the sports investment strategies. The portfolio's agriculture and marine leasing strategies also performed well during the quarter. Speaking of that, absolute overweight to global public equities contributed between 32 and 40 basis points of outperformance at the total portfolio level during the quarter. But that outperformance tailwind was offset by the underperformance of the public equity portfolio relative to the benchmark. Joe's going to talk about that, but active management continued to struggle in what was still a fairly narrow market. And that relative underperformance cost the portfolios between 29 and 45 basis points at the total portfolio level for the quarter. For the fiscal year, glad to close the books on a very strong fiscal year with very strong performance across the portfolios. The KRS pension composite produced a return of 12.49%, outperforming the blended benchmark's return of 11.54%. And the insurance composite produced a return of 13.18%, outperforming its benchmark by 98 basis points. Individual portfolio performance for this fiscal year ranged from 12.09% to 13.58%. And importantly, all of the portfolios outperformed their respective benchmarks by between 90 and 114 basis points. On a dollar basis, that equates to about $77.8 million of outperformance for the pension composite and $30.6 million for the insurance composite. During the fiscal year, the specialty credit, real return, and core fixed income portfolios all outperformed their benchmarks and were the main drivers of that outperformance to the total overall portfolio benchmark. Real return produced 924 basis points of outperformance. Specialty credit produced 209 basis points of outperformance. And core in fixed income, which is usually obviously it's a smaller overall return, but was still produced 37 basis points of outperformance relative to its benchmark. The overweight to public equities also benefited portfolio performance, contributing between 45 and 54 basis points, which was offset again by public equities underperformance relative to its benchmark of 247 basis points for the year. Kind of looking forward, July was a month of competing narratives. We saw renewed conflict in the Middle East, a sharp unwind in that momentum and AI-related stock trade that David pointed out for the last quarter, and a chorus of hawkish central banks globally, not just in the U.S., all while underlying economic data continued to hold up pretty well. Public equities were overall able to hold steady despite that sharp decline in high-flying tech names. Treasury yields jumped, as David mentioned, and oil soared as volatility reignited. That permanent resolution to the conflict in the Middle East has proved pretty elusive. It's continued to this day. For the month, the S&P was flat, while the NASDAQ 100 fell by over 6.5%. So really a rotation in public equity markets. We've seen a reversal of some of that in August. So it really is a month-to-month, week-to-week kind of trade. Core fixed income fell 130 basis points, while high yield was flat for the month. Looking at July returns, still preliminary, but current estimates are for the portfolios to be down about 25 to 50 basis points for the month. We remain broadly constructive, but I like to say selective on risk assets. And that's supported by the evidence. We talk about AI a lot. There's initial signs that it's moving from promise to monetization, and broader corporate earnings strength suggests that the profit cycle is widening, which really could reduce that reliance on a narrow group of mega cap leaders. And private sector investment, as both Craig and David talked about, is beginning to replace some of that government-led demand support, which would be healthy for the economy longer term. The totality of the labor market data suggests that the broad employment picture remains relatively robust and in good shape, and points towards continued moderate wage growth, which will support consumer demand that to date has remained relatively resilient in the face of that elevated inflation. But just like we saw with last quarter and the first 2 months of this quarter, markets are likely to remain volatile. They continue to face a range of fiscal, monetary, and geopolitical crosscurrents. And the cycle we're in is likely to be uneven. As we see globally, the economy remains pretty solid, but unsynchronized expansion mode. Inflation, I think that's going to be the hot topic still, is expected to be sticky, and will remain elevated even as temporary supply shock induced inflation appears to be fading. The potential productivity benefits that Wilshire talked about of AI, that ultimately I think that's where we may lead. That should support medium-term disinflation, but the build-out is likely to result in a strong inflationary impulse on the upfront side. We're seeing that day to day, as they both mentioned, both spending cash flow as well as raising debt to build out AI. I think that's going to have some inflationary component as we move forward. Ultimately, that shifts hopefully to a disinflationary for the broader economy. While short rates have been driven by interim inflation and monetary policy expectations, Wilshire did talk about the long end of the curve has been driven by higher real rates. And this higher rate environment appears likely to persist, which we know raises the cost of capital and may become a drag on economic growth, but should provide attractive new investment opportunities, things that we look at on a day-to-day basis. Finally, as we talked about many times, and as you saw in Wilshire's capital market assumptions, we're at current environment, I think it's hard to categorize anything but maybe premium valuations. We always think of future expected returns. There's a starting point bias to all of those. And that premium valuation is across a number of markets and asset classes, but especially we think in U.S. equities. That tempers our constructive optimism, but we do believe that dispersion across regions and styles really may offer pockets of relative value opportunities that we in our construction can take advantage of. We look at that on a daily basis, and Joe will talk a little bit more about that, especially in a public equity market. If we jump to page 52 quickly. These are the internally managed portfolios, and all of the internally managed portfolios performed in line with expectations and objectives during the quarter and for the full fiscal year. As we remind everyone, the majority of these assets are passively managed and intended to replicate the return and risk of public indices, really providing inexpensive beta exposure to more efficient markets, while also providing staff flexibility and rebalancing the overall portfolio's asset and risk allocations. I would note, while the real return portfolio with its commodity exposure underperformed during the quarter, it produced very strong performance for the fiscal year, returning over 31%. If there's not any questions there, I'll turn it over to Joe to cover public equities.
All right, sorry about that. Having some computer issues. If you'll go to slide 60, please. Try to run through this relatively quickly. U.S. markets, we've kind of touched on that a little bit, had their strongest quarter in 6 years in 2Q26, reaching market all-time highs. This was fueled by the AI infrastructure spending and a strong earnings season. Steve mentioned the market is beginning to broaden out, which we're hopeful that will benefit the portfolio. However, it's still pretty narrow within market cap segments, and that broadening out kind of took place towards the end of June. Small caps did outperform. Growth led the market. High beta and low quality names outperformed, which was kind of a headwind that's going to be seen throughout our entire portfolio, really, that we'll touch on. There was a significant leadership shift from Q1 to Q2. It was interesting. Energy was up 37% in Q1, just to be down 14% in Q2. And then tech down 9% in the first quarter, up 31% in the second quarter. So just a little bit of that shows the volatility within the markets and kind of difficult to navigate for our active management. I think David mentioned some of the factors. Momentum factor has been strong for quite some time. Volatility has been as well, although that momentum factor showed a little bit of signs of fading in the second quarter. We don't have a ton of dedicated momentum factor exposure, so that's been kind of a headwind for the portfolio for a while. We still see opportunities in AI infrastructure. Some of the software names that really got hit earlier in the fiscal year have kind of rebounded as there's been a little bit more discernment, kind of that AI scare that hit across the software industry, being a little bit more choosy now. Still cautious around any type of long-term duration growth that comes with a high valuation. Let's go to the next slide, please. Non-US markets strong. Absolute performance, they trailed the US a little bit in 2Q, also dominated by AI capital spending, specifically within semiconductors and tech hardware, incredibly narrow in some of the emerging markets. The EFA technology sector, for instance, is kind of the developed side of the region, up 55% in the quarter. Geopolitical events, the effects of those were relatively muted as investors paid more attention to corporate continued growth in corporate profits this past quarter. Low quality dominance that's been an issue for our portfolio for quite some time has really faded throughout the fiscal year. That middle chart kind of shows the developed quality index versus the developed core. And typically quality is going to trade at a premium. However, at the beginning of this fiscal year, it was trading at about a 15% discount to the core. So that's been a headwind for some of our active managers. Throughout the fiscal year, that kind of trended towards more historical norms. Hopefully that continues. But overall, the non-US markets seem relatively resilient, based in part due to their starting point being at better valuations, but also earnings really starting to come through in those markets as well. We'll slide to the next slide. I guess it's going to be 62, I believe. For the quarter, our global equities returned 14.3 versus 14.9. Stock selection weakness was the main issue there, particularly in the international markets. We did have a slight underweight to U.S. equities, which hurt us in the quarter. The U.S. equity portfolio did return 15.1 versus 15.4. Stock selection split across our active mandates. Really, the all-cap value mandate struggled. We do tilt a little smaller, so that helped during the quarter. And then within the non-US portfolio, returned 12.8 versus 13.8. This is going to be primarily issues within our developed country growth mandates. Also, EM value mandate struggled, and we'll talk more about that here in a moment. But this was partially offset by good performance in our international small cap manager, as well as from our EM growth allocation. Next slide, please. And this is on the fiscal year. Strong absolute performance, 21.7. Unfortunately, benchmark 24.2. And so while we enjoy the strong absolute, disappointed in the relative. Broadly speaking, we had individual strategy performance that was just challenged mainly from a style and factor weakness. Low quality, high volatility headwind was persistent throughout the portfolio. This was partially offset by our regional positioning. We were heavier non-US markets. They outperformed the US by just under 4% on the fiscal year, so that helped us a little bit. Within the US allocation, we returned 21.6 versus 22.8. The active managers were broadly weaker, with the exception of our microcap strategy, which performed really well. This weakness partially offset by the internal portfolios that were added a little bit over their indices. We also had a little bit of a tilt, like I said earlier, to smaller cap. Small caps outperformed, almost doubling up large caps over the fiscal year, so that helped us. And then within the non-US portfolio, this is where we really struggled. Returned 22%, so the absolute was good. However, the index was at 26.5. A lot of this comes from trouble within our growth part of the portfolio. If you recall, we talked about Franklin Templeton being kind of an issue within the portfolio for some time. There was some style headwinds. They had some stock selection issues. They had some outflows from investors, so we moved on from that. But of that 4.5% underperformance on the fiscal year, that strategy accounted for about 2.6 of that. So that's been mitigated going forward, we hope, but still flows through in this year's performance. The EM value mandate struggled in the final quarter of the fiscal year. We'll talk about that. Is a kind of interesting. This again partially offset by our deep value developed manager did well, and our EM growth mandate did well. And then if you'll go to the next slide, this is maybe a newer slide, kind of a contributor and detractor on the fiscal year. We'll spend more time on the detractors explaining them, but real quick on the contributors, Next Century, that's the microcap strategy, added 66% over a 51% benchmark. Started the year kind of difficult. It was pretty speculative. Biofarm in the microcap space did really well. They don't have any real direct exposure to that, so they started out the gate stumbling a little bit. Did really well in the second quarter of 26 with an overweight to technology. They kind of shifted into that at the right time. And so that helped propel them to a good fiscal year for us. LSV is a deep value developed and emerging market mandate that we have. Value has been a tailwind, frankly, in the non-US space, so that helped them. But they provided a 42% return versus 28. Consistent performance throughout the bulk of the fiscal year. It's a quantitative strategy, so their valuation factors on book to market and on earnings really came through with stock selection. And so that one did well for us. JP Morgan Emerging Market, I've got them listed there as the MSCI EM index. It's actually the MSCI EM IMI, which just adds the small cap component of emerging markets. They performed, providing 58% versus 41 on the year, primarily through stock selection. They did really well in the technology sector with the semis and in the memory space. Did pretty well in financials as well. Not in the banking wasn't what drove it, but in wealth and asset management. For the detractors, I, for whatever reason, didn't list the Franklin Templeton strategy on this page, probably because it wasn't in the portfolio as of 6/30. But that was about half of our underperformance in the non-US space. But we did have issues in the portfolio. River Road underperformed by about 25%. Over 15% of that came in the last quarter of the fiscal year. It faced some significant factor allocation headwinds, the largest ones it's faced in the history of the strategy. High beta stocks outperformed low beta stocks by 48% in the quarter. They don't really have any exposure to those names. Also, the more expensive names, the most expensive quintile, for instance, in 2Q, I believe started with a PE around 16.8 and the Russell 3000 value. It ended up the quarter just getting more expensive around 24. This strategy, they tend to start exiting positions around a 15 multiple. So they just had no exposure to what really ran in the market. And that showed in the relative performance in 2Q, especially from that big kind of trough of the underperformance of the relative performance there, and things starting to broaden out in late June. The strategy started to pick up and turn around a little bit, and through that 6/22 through the end of July, added 400 basis points on the index. To be honest, I'm not sure that this is the most appropriate benchmark for this strategy, the way it's built. And if you want me to get into that, I will, but you might be bored. But they just don't have the ability to invest in the names that ran really well this fiscal year. It's an analyst-driven portfolio. They can only pick stocks from the universe of River Road held securities, which is only about 200 names. We're putting them against an index that's got 1,500 to choose from. And the more expensive stuff in that index worked. They have no ability to even really invest in that. So maybe not the most fair comparison from a benchmark perspective, but that is the story, and that's how it's been benched for this fiscal year. American Century underperformed. This is a story primarily of risk factor headwinds that accounted for about half of the underperformance. The value headwind for them, this is a growth mandate, explained a good bit of that. There were some stock selection issues, not from a pick names that blew up necessarily, but by not having the right name. So they did have exposure to the semiconductors, but they didn't necessarily have exposure to smaller companies within that supply chain that did really well. They viewed that as companies that kind of had that one-time bump in this cyclical upswing, that they didn't necessarily view them as being a sustainable growth stories. So they didn't have exposure to it. So that's kind of the story there. Pazina, this is a strange one in that they were, for the first 3 quarters of the fiscal year, they were up 5% over their index, and then dropped 23% relative in the months of really April and May, I believe, were the two that really hit them. And this was kind of that South Korea story that David spoke about, the semiconductors, memory names. So TSMC, Samsung, SK Hynix, those really drove the entirety of the index for that quarter. They were underweight a couple names based on valuations. They're a value manager. They didn't have any exposure to SK Hynix, which had a really strong quarter. And so really being underweight those positions is the story of that quarter. They viewed them as being at their margins being at cyclical peaks. They weren't interested in paying up for that and chasing that. And then in July, you heard Steve mention there was a bit of a rotation in some of those AI names. They were able to add 10% over the index in the month of July. So some of that's been brought back. Really, the story for these three detractors were less about bad stock selection in terms of losing money and more about them performing with and executing on the philosophy of their process, holding names that performed from an operations perspective, but that the market just did not reward from a stock price perspective. And so we don't like the underperformance. I understand why it's there. No real concerns with Pacina at all. We're going to watch River Road and American Century closely, but we're not ready to make any calls on that at the moment as far as any changes or anything like that. Next
Hey, Joe,
slide. Yes.
if I could just add one comment about all the public equities, I think is relevant to what you're telling us. Over the attempts to outperform have been very challenged over the past 1, 3, and 5 years across global equity markets, U.S. and non-U.S. With the strength of these markets, globally, market indexes are running around the top 30% of universes, so indicating 70% of attempts to outperform have failed. So a lot of what we're just all seeing, that's been a real challenge.
Yeah, I appreciate that. It has been for most of the active managers, and that's kind of the last slide is going to kind of touch on that a little bit. Let's move one more slide, please. There you go. So despite the absolute strong performance, portfolios failed to keep up with their benchmark. It's been a fiscal year that just provided difficult environments. They've just kind of touched on that. The narrowness of the market's been an issue across our portfolio. Diversification, we believe in that. However, in markets this narrow, it actually is a risk factor to your performance. And so it just makes it where it's almost impossible to keep up. High beta, low quality names that are at high value, trading at high valuations outpace their counterparts. We just don't build strategies where we pay active investment managers to go buy expensive, low quality companies. That's just not a winning proposition, in my opinion, over the long term. However, in the short term, it can rule the day. It did this fiscal year where certain risk on environments occur and people don't pay attention to the valuation. Momentum trades occur where people aren't concerned with what they're paying to be involved in that. And so there's short-term periods where we're going to underperform. This is one of them. Kind of talk a little about positioning there. The next little bullet point, we're underweight domestic markets intentionally. Within the domestic markets, we have a little bit of a nod up cap and down small cap as well at the expense of mid caps. We have a little more developed market than emerging market in the non-US piece. Overall allocation was additive. However, the structure of our portfolio sometimes makes managing that position difficult. And what I mean by that is where we've allowed all cap managers the freedom to move up and down cap spectrum, where we have ACWI US mandates where they can move between developed and emerging markets. Sometimes that positioning is difficult to monitor. We try to stay on it. We may have to get a little more aggressive in that to make sure the tilts that we want and that are intended are there. You've heard me in the past mention one-off names before. I don't know that we've ever really shown how the portfolio is structured and built together. And so that's these two boxes to the right kind of do that. The green's your US allocation, and really from top to bottom, that kind of moves market cap from large down to small or micro actually. And then left to right's value to growth, and those pieces, how they kind of fit together. It's not necessarily drawn to scale, but it's close. And then in the non-US, similar, you go large down to kind of mid. We do have some international small cap. You'll notice there's kind of a hole in that one. We don't have much in the way of international small cap value, so that might be something to look at. But I just wanted to kind of show you graphically a depiction of kind of how these blocks fit together. That's all the prepared stuff I had. Happy to take questions if there are any.
And Joe, just to add to David's comment as well, there's a lot of research coming out recently too about, there's the growth of price agnostic public equity mandates. So index tracking, I think the common refrain is that, there's more ETFs in the world now than there are individual stocks. And that price agnostic, so there's not any analysis done on relative values for those stocks, and for active managers, obviously that's a big component of what they do. So they're price takers, some of these mandates, and the growth of those has been, I think, a headwind. Others will argue otherwise, but I think it's been a headwind for active management as well. And I think what Joe points out, I appreciate this is great work, Joe. I know it's obviously wasn't a great year to be in the spotlight for you. Great headline numbers, but on a relative basis, it was tough. But I think it also argues for, how we construct and the diversification, and the asset allocation work that you guys, the trustees and Wilshire does, provides us, and the durability of the portfolio. I never liked that term, but the durability of the portfolio that we've built. So even with the public equities broadly, our public equities underperforming their benchmark, if we jump back to the total fund performance, still able to outperform given the strength of the other asset classes at the total fund benchmark level. So I think that's something important to keep in mind when we see one asset class struggle. We have other areas where we're outperforming, which really contribute to the overall fund.
Right. And I guess the only thing I would add to that is these narrow markets, and as strong as they have been based on the narrowness of it, has been difficult for active managers to really add any value. We would expect them to be able to do so with a broadening market, and even potentially a market in a downturn. So from a relative perspective, that would look good for me, but then we're losing money for the system. We don't like that. And so it's difficult to win on either side of that trade, but it is what it is. So we're continuing to try to find ways to build a little bit better portfolio. So.
Well, thank you, Joe. Appreciate all the work. Brian, I know we covered a lot of the fixed income market, but if you want to touch on anything in the core, the liquidity, and especially the credit space, I'll turn it over to you.
Sure, I'll be real quick. Mary, I'll start on page 67, please. Thank you. Core fixed income still generated a positive return even as yields rose, of 84 basis points for the quarter and 416 basis points for the fiscal year, outperforming the benchmark by 17 and 37 basis points respectively. The main drivers of outperformance were overweights to credit and securitized products, specifically mortgage-backed securities and asset-backed securities. For the quarter, the option-adjusted spread for credit tightened 15 basis points, and for the fiscal year, tightened 9 basis points. Within the credit sector, technology lagged other sectors as elevated issuance from AI-related names and upward revisions to capital expenditures weighed on the market. While securitized products performed well for the quarter, generating 30 basis points of excess returns, it was the strong fiscal year performance of 197 basis points of excess returns, helping the portfolio for the year and outpace credit by 34 basis points. Next page, please. The specialty credit portfolio earned just over 2% for the quarter and generated 723 basis points for the fiscal year, outperforming the benchmark by over 2%. Over longer time periods, the portfolio has returned just over 9.5% over 3 years and just under 7.5% over the last 5. Lower quality issues outperformed during the quarter, with CCC rated securities returning 128 basis points more than BB rated securities. For the fiscal year, single B rated issuers led performance, returning 616 basis points in total return. And next page, please. High yield spreads tightened 53 basis points during the quarter to an option adjusted spread of 275. The current spread level is well inside the long-term average of 519. For default activity, there was a spike in the reported rate of 2.67% due to the DISH prepackaged filing, which accounted for 70% of the quarter's activity. And next page, please. Team Wilshire already hit a lot of these bullet points. I'll just let you know that for the quarter, cash generated 91 basis points in return and 4% for the fiscal year. This is the last page for me. I'm happy to take any questions.
If not, I'll turn it over to Anthony to briefly cover private markets.
Yeah. Okay. I'm still having problems with this, but let me try. We can go to the next page, 71, please. Thank you. This is again private markets. They've been broadly positive as we've said those quarters. Back to what we were talking about previously. Private credit and some real assets have outperformed private equity actually over the past 1, 3, and 5 periods, or at least kept up. And obviously saw the Wilshire projections of them continue to do that going forward. Go to the next page after that. Real estate has been in a tough way. Again, it has some of the same characteristics as private equity, a lot of dependence on leverage, which has obviously become much more costly and decreased the valuations of all the assets. So the one thing that is a little different about real estate is the supply part of it, since these are used, and there's the supply has fallen off a lot in terms of the starts. As you can see on the chart on the right, that's a lot of different types of real estate starts that have decreased sharply since interest rates have gone up. So eventually the results of that are felt. You hear some managers starting to talk about that. I think our industrial manager, Prologis, specifically is trying to call a turn. But you can see just how far down the supply has gone. Like the orange line is senior housing, which is what another one of our managers specializes in. And I'd say we know from just the news and also, who we support, our members, the aging population is growing. The demand for this is not going down. So eventually this will hopefully benefit the existing assets and the assets that are being developed by our managers. So even the light blue line that's minus 49, that's multifamily units. Of course, that's specific to different areas, right? Certain areas in our country were overbuilt for that during the recent boom, and that's getting absorbed in other areas. It's very difficult to build, so I think those areas are still quite constrained. So it just depends. It's hard to paint it with a broad brush, but it's been difficult in real estate, as you can tell from the low returns there. I think the interesting point that I didn't realize until I made this chart was that cash beat real estate in all periods over the past 5 years. What makes me better off of that? It's hard to know that. At AT&T, and also, again, back to diversity, we're trying to have that's robust in all kinds of different situations. But yeah, it's been a difficult time here. All right, next page, please. This is real return. It's been a different story. Obviously, this is a portfolio we try to build of things that are scarce and have contracted cash flows and just are going to perform differently than the rest of our portfolio. As Steve mentioned, NBA or sports investments and our energy investments fit this bill. on the bottom part, that's just a graph of the NBA media contract that took effect. You can see that the rights went up 8% just in for the initial bump, and then the rest of the contract is a 7% CAGR. So that's just new extra money, additional money for the owners, teams, investors, I guess, to that should increase the values of the assets. Then on the right is from one of the earnings calls for one of the public companies that is in our midstream portfolio, and this just talks about some of the pipeline assets that they're developing to meet some of the data center demand that requires lots of energy. Go to the next page, please. This is for private equity. Again, these are some of the same charts. Some pretty stuff. One is talking deals, and the deals number of routes. There's a lot of hope for more this year, and that just says out of some of the deals that we did so far, and then I may. Let's see.
Steve, I don't know if Anthony's talking or not. I just hear.
Yeah, I think he's having trouble.
I'm having
I
phone
think
trouble. Sorry, can you not hear
Yeah.
me? Is
now we can.
that better? Sorry. All right, can you flip to the next page, please? This was just the next page is 75, I think. This is about our portfolio. Specifically, I mean, I think the last page I was trying to talk about how things were a little bit hung in the market. We still have had some transactions occur, and so we've been getting some money back. The left side talks about the big deal in our Bay Hills portfolio that we were mentioning. It's a significant exposure for us, and that's being bought by Strategic, Parker Hannifin. And then the bottom right is 3 companies that were also exited during the quarter. Two to other private equity firms and 1 to a publicly traded company. So we are seeing some distributions back despite the difficulties in the market. And so that's something we wanted to highlight to you all. And that's it. Does anyone have any questions? I'm sorry if you couldn't hear me very well.
Yeah, no, thank you, Anthony. And I do think, and probably what Anthony was mentioning on the prior page as well, is, we talk about the hung companies and the value and the number of companies, but you're also seeing some headlines with, increasing distributions or realizations. And my only caution there is it's heavily skewed towards a number of very large deals, mega deals, I think, is typically what they're called, and not a lot of activity under that headline. As far as small, mid-sized portfolio companies transacting. So it's very skewed to the heavy. So the top line number looks a lot healthier, in my opinion, than some of the underlying data might indicate. With that, I'll jump. Obviously, we're running here an hour and a half in. I'll jump quickly to a couple other things to touch on. Page 108, please. Everyone knows some of my favorite charts that Wilshire produces for us, and just really to point out that all of the pension and insurance portfolios have continued to produce, what we think is very important, strong risk-adjusted performance, within the top quartile or decile performance over the last 3 and 5 year time periods based on Wilshire's all public plans universe with all of the portfolios. Again, we always believe that's an important metric. It's the asset allocation guidelines provided by the investment committee and the board determine the specific risk parameters and constraints under which we construct the portfolios. And these risk-adjusted returns really demonstrate the efficiency of the performance that's produced by the portfolios. It's that time of year, fiscal year end. We see a lot of numbers coming out. I'm sure you'll see headlines on other systems and benchmarks. Pure universes as Wilshire provides here. I would also say this was another year where Larger plans tended to underperform, and that's primarily because they usually have a lower exposure to public equities. Within Cowen's all plan universe, the median was 14.7 for the year, for the fiscal year. But that really, the small plans for them, which is under 100 million, having larger exposures to public equities, the median return was 15.6%, while the larger public plans, which have larger exposures to alternative and private assets, which underperform public equities in the last fiscal year, had a significantly almost a 150 basis points lower median return than those small plans. Could move to page 120, please. Very quickly, just always like to point out that as of the end of the fiscal year, all of the asset classes were within their IPS specified range. And the majority of the positioning is indicated by those triangles are within 50, maybe 100 basis points of their respective target allocation. So we're managing fairly tightly to those ranges. Private equity, as we always talk about, is the real outlier there. As we talked about time and time again, it's been less appealing from a risk reward profile relative to other asset classes. Now we are starting to see some opportunities, including the recent Keystone investment that was approved by the investment committee and the board. And that's broken record, but as underperformance and funding difficulties in the sector have created some more unique and compelling opportunities that we continue to evaluate. Page 158. Very briefly touch on the budget here. Headline, I can say that we came in 5.3 million under budget, having spent only 6.5 million or 55% of the amount budgeted for the year. I would love to take all the credit for that, but almost the entire amount was the result of only spending 450,000 or 8% of the amount budgeted for legal expenses. So I guess we can really thank Vicky and Michael. All of the other budget items really were in line. I would note that the expenses for custody services were almost 500,000 more than budgeted. That was primarily as a result of the increase in overall market values and increase in transactions and number of accounts. I would also note the ISS expense was more than budgeted, and you will note additional increase in the amount budgeted for fiscal 2027. As a reminder, ISS provides proxy voting and securities litigation monitoring and filing services for the systems. We have seen a modest increase in fees based on the number of proxies voted for the systems, but the larger increase is really due to the increase in scope of securities litigations filing that ISS is doing on behalf of the systems. ISS is now responsible for monitoring and filing both U.S. and non-U.S. security litigation claims for the system, so we feel we have full coverage there. The total amount budgeted for fiscal 2027 is 10.8 million, which is a reduction of 1 million or 8% from the budget for fiscal 2026. The largest decrease, thank legal again, which was 1.6 million or 28% less than what was budgeted last year. This was driven by settlements having been reached or expected to be reached in a number of cases. As always, Michael did want me to caution that this is a very difficult category to budget. And depending on actions and the remaining open cases, we could see a significant increase in overall legal expenses. Page 161, please. Drilling down specifically into investment fees and expenses at the total pension level, investment fees and expenses declined by 12.3 million or 8% from the prior year, and that's despite a 14% increase in total assets. The largest drivers of this decline were the 17.4 million decrease in performance fees and expenses in the specialty credit asset class, and the 13.4 million decrease in performance fees for the private equity asset class. These decreases were partially offset by the increase in the total investment management fees across all asset classes, largely driven by, again, that increase in market value of each asset class. The largest increase was in the real return asset class, which increased by 7 million as staff has continued to build out portfolios towards the respective asset allocation targets, increasing assets by a little over 400 million or 28%. At the total pension level, on a weighted basis, the overall investment management fees are approximately 30 basis points on an annualized basis. The combined KRS pension portfolio is roughly in line with that, with a weighted management fee rate of about 28 basis points. Core fixed income has the lowest weighted average at 6.1 basis points. That also includes the internally managed portfolio. While the real estate portfolio currently has the most expensive weighted management fee rate of approximately 82 basis points. Quickly on updates on custody, I think we talked about that initially, but the custody RFP is in process. Is moving forward. I think committee is settled. The RFP itself is nearly finalized. And Vicki and I continue to work on a contract for cost efficiency services. So that's all we have. Happy to answer any questions.
Well, if no questions for Steve, I believe Carrie is up next.
Yes, I will. Oh, I think Miss Hampton has her hand up. Miss Hampton, you're on mute.
Steve, when do we turn all the results over to the actuaries?
I think once the total fiscal year end numbers are done, so I think that should be, I think Mike Lamb might have an answer for that, but I think that, we've wrapped up, closed the books on fiscal year end, so I think that probably is either in process or nearly done.
Okay, I'm expecting it's going to look pretty good. So thank you.
Well, hopefully we can keep it up. We'll see what markets provide.
I'll keep it short and sweet. Mary, could we just go to page 168, please? I don't have any issues or problems to make the committee aware of in the quarterly compliance report. I just wanted to highlight that the KRS board did approve some changes to the investment guidelines and its investment policies at the June 2026 meeting. And I'm working with our in-house staff and BNY to implement some of those changes. I think the earliest you might expect to see the reports with the updated investment guidelines in it would be for the quarter ending December 31st of this year, which would show up in the first meeting of this committee in 2027. That's the earliest I think we can expect to see those changes implemented. It just takes a little time, and I want to monitor the full quarter under the updated guidelines. So just wanted to provide an update on that, and unless there's any questions, that's it.
Thank you, Carrie. We always like a clean report on compliance. And with that, if no one has anything else to add, this meeting, I will unilaterally declare adjourned.
Thank you.
Great, thank